Hey everyone, welcome back to Corporate Decoder. Today we're diving into a Form 8K filing from HPS Corporate Lending Fund, and let me tell you, this one's all about debt. But before you yawn, it's not just any debt. It's a multi-layered, intricately structured kind of debt, like a financial lasagna. We'll see if it's delicious or gives us indigestion. So on March 5, 2025, HPS Corporate Lending Fund reported something big. They finalized a $1.254 billion debt securitization. Securitization is just a fancy word for packaging a bunch of loans together and selling them off to investors as securities or investments. It's like taking a bunch of mortgages and turning them into bonds, if you remember the 2008 crisis. This particular securitization is called a collateralized loan obligation, or CLO for short. CLOs are a way for companies to raise money by packaging loans they've made to other companies. In this case, the fund is packaging up loans they've made to middle market companies. To make things even more interesting, they didn't do this directly. They created a subsidiary, a daughter company called HLEND CLO 2025-3 LLC to issue the debt. Think of it like setting up a special purpose vehicle, a separate bucket to hold all this debt. Now, what kind of debt are we talking about? There are different layers or tranches of debt. First, there are Class A loans, then Class A notes, Class B notes, and finally, subordinated notes. It's like a waterfall where some investors get paid first and others get paid later, depending on how well the underlying loans perform. Let's talk about the money, focusing on the interest or the coupon. The Class A loans and notes have an interest rate of SOFR plus 1.40%. SOFR is a benchmark interest rate, and the 1.40% is added on top. The Class B notes have a slightly higher interest rate, SOFR plus 1.70%. The subordinated notes don't have a stated interest rate because they are the first to take losses, but they get a potentially higher return if everything goes well. Speaking of subordinated notes, a wholly owned subsidiary of the fund retained all of the subordinated notes issued in the 2025 debt securitization. The fund is keeping all of the riskiest part of this debt package. This could be good because it means they believe in the underlying loans, or it could be bad because if things go south, they're on the hook. To sell the debt, the 2025 issuer, the daughter company, hired JP Morgan Securities LLC as the placement agent. A placement agent helps find investors to buy the debt. This is a common practice in these types of transactions. HPS Corporate Lending Fund will manage the underlying loans as collateral manager. This means they're in charge of making sure the loans are performing well, collecting payments, and generally keeping things running smoothly. It's like they're the gardeners tending to the financial plants. The company isn't charging fees as long as it is the collateral manager. This is interesting. It signals that they are willing to manage the collateral for free, perhaps because they are confident in the debt portfolio or because they want to keep control. The debt is scheduled to mature in January 2037. That's over a decade from now, a long time in the world of finance. However, the debt can be called or redeemed earlier, starting in March 2027. It can be redeemed either by the subordinated noteholders or by the collateral manager. As part of this deal, the fund sold the loans to its subsidiary, the depositor, who then sold them to the 2025 issuer. This is all part of the legal structure to isolate the debt from the rest of the fund's assets. It's like building a financial firewall. The 2025 issuer also entered into a credit agreement for $25 million with some Class A lenders. So in addition to all the notes, there are also some direct loans. It's debt on top of more debt. The secured debt and the subordinated notes haven't been registered under the Securities Act of 1933. This means they were likely sold to sophisticated investors in a private placement, not to the general public. Private placements have less regulatory oversight. This filing also mentions the creation of a direct financial obligation, which just means they are acknowledging that this debt has been created. And finally, at the end of the report, there are exhibits attached, like the placement agency agreement, the indenture, the collateral management agreement, the sale agreement, and the credit agreement. These agreements lay out the details of the deal. So, what does all this mean? HPS Corporate Lending Fund has essentially created a $1.254 billion package of debt backed by loans to middle market companies. They've sold off different tranches of this debt to investors, keeping the riskiest part for themselves. They're managing the underlying loans, and they're hoping everything performs well so they can pay off the debt and generate a return. Now let's put this into context and give you my thoughts. HPS Corporate Lending Fund is making a big bet on middle market companies. They are taking on a significant amount of debt to do so. The strength of this strategy depends entirely on the performance of those middle market loans. One risk here is the overall economic environment. If the economy slows down or interest rates rise, these middle market companies might struggle to repay their loans, which would impact the value of the CLO. This is why the rating of the debt and its repayment structure is important. The fact that they are keeping the subordinated notes also means that their incentives are aligned with the CLO performing. On the other hand, there is opportunity as well. Middle market lending can be a lucrative business. If they are good at picking companies that will grow and succeed, this CLO could generate strong returns for both the fund and its investors. Also, by securitizing these assets, they free up their capital to lend to even more companies. Overall, this CLO seems like a calculated risk. HPS Corporate Lending Fund is leveraging its expertise in middle market lending to create a complex financial product. The success of this venture will depend on their ability to manage the underlying loans and navigate the economic environment. Thanks for watching. If you found this breakdown helpful, please like, comment, and subscribe for more corporate deep dives. What do you think of this debt securitization? Let me know in the comments below.